Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. On today's YouTube Live, everything you need to know about the Roth IRA conversion, Backdoor Roth IRA. I'm going to talk about what a Roth IRA is, how do you get into a Roth IRA, contribution rules, distribution rules, and we're going to get into all the fun stuff, conversions, backdoor Roth IRAs, and ultimately some strategies for taking advantage of Roth conversions. And really, ultimately, I believe the best and most powerful legal tax shelter out there. Some will argue life insurance. I would probably argue Roth IRA. I wrote a book. Actually, I've given away so many of my books, but I actually don't have one right here with me. But the book I wrote several years back, In God We Trust and Roth We Prosper, I truly believe that. All my retirement accounts are in Roth. I'm what you call a Rother. And I believe that so long as I continue to be patient, once I'm 59 and a half, which is not as far off as I once thought, and my Roth will clearly be open at least 5 years, whatever I need to live on or live off will be tax-free. Okay, that's my bet. I am going to resist taking a tax deduction now, like I could with a pre-tax IRA or a pre-tax 401k. And instead, I'm going to take and make an after-tax contribution, not get a deduction, but know myself, know that I'm a patient person, and know that I'm willing to wait till I'm 59 and a half or later. And then once I do, everything I pull out of my Roth IRA will be tax-free. So not only is it an amazing tax shelter when you're alive and you're living, but it's also a great legacy, tax-free legacy gift that you can leave to a spouse or child or a non-spousal heir, where they'll have 10 years to pull those funds out tax-free. Okay, so I'm going to talk about all this stuff, just a little bit about me, you know who I am. This is probably one of my favorite topics, to be honest. I love talking about Roths. There's just so many amazing things you could do. And I've had the privilege of talking to some really, really, really smart clients, non-clients, just folks that I've been able to interact with over the years that have done some really, really cool stuff. And I definitely don't want to divulge too much. A lot of the stuff I kind of retain in confidence, but I'm going to get into some strategies today for some conversion strategies. And ultimately, in a future video, we'll go through some Roth investment strategies as well, because Roth is, as I mentioned, probably my favorite topic. So real quick, the Roth was created only in 1997. Right? IRAs were created in 1974 by ERISA. Roths were created 23 years later by Senator Roth of Delaware. And the concept behind a Roth was basically, hey, let's encourage more people to save, and let's find different ways to encourage them to save. And the traditional IRA, the framework is based off two premises. One, let's encourage people to save. We're going to give them a tax deduction for what they put in the IRA. And then ultimately that money in the IRA will grow without tax, which is known as tax deferral. And what Senator Roth wanted to do is he said, you know what, let's do something different. There are some folks out there that aren't as interested in the tax deduction, because at that point in the 90s, the max IRA contribution was only a few $1,000s. So the deduction wasn't very exciting to some folks. And there was a need to really increase savings amongst Americans. So I give Senator Roth a lot of credit, and he's basically said, okay, let's do something different as an alternative to the traditional IRA. And the Roth IRA is born. And what it is, as I mentioned, it's an after-tax IRA, so there's no tax deduction. But so long as you're over 59 and a half, the Roth's been open 5 years, everything you pull out is tax-free. Now, contributions to a Roth, you can pull out anytime you want tax-free. So if you put $5,000 in a Roth IRA today, you can pull it out tomorrow tax-free, okay? And we'll talk about Roth conversions, which have different rules from Roth contributions. But Roth contributions and the Roth IRA distribution order, you can always take them out tax-free. So there's a lot of cool stuff you could do, right? Let's say you're 25 years old, and for the next, 10 years, you put $5,000 in a Roth IRA. Okay, that's $50,000 in contributions. That $50,000, that first bucket, could always be taken out tax-free. So if you're short on money, medical bills, credit card bills, whatever, that money is always available to be pulled out. The earnings, which we'll get to in a couple slides, that you have to wait to 59.5 in the 5 years. But the contributions are always permitted to be taken out as a distribution tax rate. So that does give you some flexibility. So Roth IRA contributions, not everyone can make a Roth IRA contribution. Hold that thought for a few minutes, because I'll get to the backdoor Roth IRA and explain why that is actually not true. But essentially, under the Roth IRA rules, if you are married, filed jointly, and make less than 240, or single, make more than 161, so more than 240, more than 161, you technically cannot make Roth IRA contributions. Okay, but we'll see there's a workaround like almost everything else in the code. You need earned income to do Roth IRAs, or you can piggyback off a spouse. What's earned income? Compensations for services, W-2, 1099, Schedule C, anything that's really subject to self-employment, Social Security tax. So passive categories of income are not eligible for Roth contributions or any IRA contributions. So that means capital gains, interest, dividends, royalties, rental income, no capital gains, okay? No capital gains, no Roth IRA contributions. So if you make $20 million a year selling your company, you can't put any of that in a Roth IRA if you have no income. If you make $400,000 on interest, no Roth IRA. That's not deemed earnings. $100,000 on dividends from stocks, not considered earnings. You need to actually only calculate and use income subject to self-employment or Social Security tax or FICA taxes like 1099, W-2, Schedule C income, guaranteed payments. That is what is deemed earned income. If you don't work and your spouse does, you can piggyback off your spouse, so long obviously as they make enough money, right? If you only made $2,000 this year in earned income, you're limited in how much you can put in the Roth IRA to that amount. You can't go above that. Okay, contributions are due April 15th, no extension. So for 2023, you have until April 15th, so still time. For 2024, you have until April 15th, 25. Okay, distributions, this is really important part of the presentation. It's really important to understand how the distribution rules work. The key is you got to be patient with a Roth IRA. The gold, this is essentially liquid gold. You need to be, you want to have a qualified distribution. So you need to be 59.5 and, not or, and the Roth must be open at least 5 years. So 59.5 years old and 5 years. It's not or. Okay, that is super important. Those are the two most important numbers when it comes to understanding how the Roth IRA works and taking advantage of the tax benefits. Because 59.5 and 5 years, if you satisfy those two requirements, everything you pull out is tax-free. Okay, which is incredible. No federal income tax, and most states will not tax it as well. So you don't have to worry about what federal tax rate is. You don't have to worry about what your tax rate is. You don't have to worry about anything else. You can literally pull that money out tax-free. If you don't need the money because you got ample resources, God bless you, you could leave it to your surviving spouse upon death, God forbid. And if you and your spouse pass, you can leave it to non-spousal heirs, and they have 10 years to pull those funds out tax-free. They can pull it out pro rata, or after, by the end of year 10, the Roth IRA must be depleted. So a couple things. Again, your ordering rules. Contributions, you can take out anytime you want tax-free. Okay. Then you will look at conversions, which we'll get to in a minute. Then non-taxable conversions like backdoors. And then the earnings. In order to pull the earnings out, you need to be 59.5 and the Roth open 5 years. So in sum, if you really want to take advantage of the all complete power of the Roth IRA, you must be 59.5 and the Roth open at least 5 years to get tax-free distributions. Okay, that's the most important thing to remember, because you can do everything right, but if you are 51 or 42 or 57 and you pull the money out prematurely, the contributions you can pull out tax-free. But it's all about the earnings, right? The juice, the alpha. That's where the Roth really accelerates, and that's where the wealth, the tax-free wealth, is built in, is the earnings, right? It's hard to really build a lot of wealth on $5,000, $6,000, $7,000 a year in a Roth IRA. For 24, you can put away 7 or 8,000 if you're over 50, right? So if you do the math, even if there's inflation and it goes up a little bit each year, like for example, in 23, the max was 6,500 or 7,500 if you're over 50. So it only went up $500. It's going to take a lot of time to build wealth that way. It's the earnings, right? It's like the Peter Thiel. I bought $2,000 of PayPal stock and I turned it into 30 million. Or I bought $500,000 worth of Facebook private stock and I turned that into 400 million. That's where the juice is. That's when I talk to clients and colleagues that have 10, 15, $100 million Roth IRAs. They didn't get there through the contributions. And they also didn't get there through conversions, which we'll talk about momentarily. They get there through the investment. And in order to shelter all the earnings from that investment and generate tax-free wealth, you must be 59 and a half in 5 years. And I want to keep focusing on that because that is the key ingredients you got to remember. If you don't have a qualified Roth distribution, you pull it out prematurely, contributions you can pull out tax-free, everything else tax and a 10% penalty. So remember that. That's painful, especially when you have the Roth IRA. So as of today, Roth IRAs can only stay in the Roth IRA world. You cannot roll a Roth IRA to a Roth 401k. You can transfer them between Roth IRAs. So if you have a Roth IRA Fidelity and you want to do alternative assets, you can move it to IRA Financial and do a self-directed Roth IRA. You can do unlimited direct transfers between Roth IRAs. Once every 12 months, you can do what's called an indirect, where you take possession of that Roth IRA, whether it's $1 or $1 million. You have 60 days to do whatever you want with it, but you must return it to a Roth IRA within 60 days. If it's not returned within 60 days, it's taxable and could be subject to a 10% early distribution penalty as well. So just remember that. In addition, and then put the house into the Roth IRA. No, if you take cash, put cash in. If you take the house out, put the house back in. So just kind of keep that in the back of your head. Roth IRA at death, it is part of your estate. You cannot get your Roth IRA out of your estate. Okay, the only way to do it is deplete it and gift it. But for most of us, $15.2 million exemption, that's our unified credit exemption for 2024. That potentially can go down in 26 to around 5 million, right? The Trump Tax Cuts Jobs Act, that was in 2017. That is some of these sunshine provisions, or some of the provisions are set to sunshine at the end of 25, including the exemption. There was some chatter, if you remember, in 2021 with President Biden, the Build Back Better, to reduce the unified credit down to 5 or 6 million. So a lot of folks did some tax planning. Today is at 15.2 million. And if you're married, obviously 30.4. So most of us don't have 30 million bucks or 15 million. So it's really not an issue if our Roth IRA is part of our estate. If it is an issue for you, God bless you. You obviously are doing something right. But it is part of your estate, but who cares, right? If you have less than $15 million, it's not an issue. There's no federal estate tax. You may have some state estate tax depending on where you live, but that is obviously applicable to your state of residency at the time of your death. There's also no requirement of distributions at age 73, which is a very important feature of the Roth. A traditional IRA has a requirement of distribution. At age 73, you have to take out approximately 3% or so a year as a requirement of distribution subject to income tax. Roth does not have that, which allows you to increase the Roth IRA value. But some other things to mention. Remember, I did mention the estate tax of 15.2 million. If you die with $100 million in your estate and you leave it to your spouse, there's no estate tax. The estate tax only applies when it goes to a non-spouse. Okay, so remember that. If a spouse takes the Roth IRA into his or her name, they just move it into their name, and then there's no tax, right? So if you pass and your wife or husband is 65, the Roth IRA is in their name, right? If they're 52, they'd put it in their name, and they'd have to wait till they're 59 and a half to be able to pull that out. If you leave it to a non-spouse, they have 10 years based off Secure Act 1.0 to pull those funds out. Okay, let's have some fun now. The backdoor Roth IRA. Before 2010, you couldn't do Roth IRA conversions if you made more than $100,000. Okay, so the backdoor Roth IRA for a lot of us was not really an option. What is the backdoor Roth IRA? Well, it's pretty simple. In a previous slide, I mentioned if you're married, file jointly, and make more than $240,000, or single, make more than $161K, you cannot do a Roth IRA. Remember, I told you that, and I said, wait, I'm going to be mentioning the backdoor Roth IRA. Well, here we are. The backdoor Roth IRA basically works as follows. Okay, you open a traditional IRA, you make an after-tax IRA contribution to it. of obviously under 7 or 8,000 if you're over 50. You then convert the after-tax IRA to Roth. And since you're going after-tax to Roth, assuming you have no other IRAs out there, it's tax-free, right? Because you're taking $7,000, I'm depositing today in a traditional IRA. I'm not taking a deduction for it. So it's deemed an after-tax IRA. And then literally that next minute or the next day, you just move that $7,000 to a Roth IRA. There's no earnings, right? I didn't buy Tesla stock. I didn't put it in a money market. I literally just kept it in cash and converted it to Roth the next day. The custodian, let's say IRA Financial, we know what a backdoor Roth IRA. We do hundreds, not thousands of these a year. We will code it on the 1099-R so the IRS knows you did a backdoor Roth IRA, so they're not going to come looking for tax money for you. We'll code it as a non-taxable conversion. And then ultimately you'll have it in a Roth IRA as a converted. Now it is a conversion. So generally you got to wait to 5 years and 59 and a half to pull it out. If you're under 59 and a half, you have to wait 59 and a half and 5 years to even take the amount converted out. If you're over 59 and a half, the amount convert you can pull out the next day. Okay, I wouldn't obviously recommend that because what's the point? But I'll talk about conversions in a second, but a backdoor Roth IRA is still a conversion. It's just deemed a non-taxable conversion versus moving a pre-tax IRA to Roth, which is a taxable conversion. Now, the way the ordering distribution rules work on conversions is if you're under 59 and a half, you got to wait 5 years and 59 and a half to pull everything out, including the amount converted. If you're over 59 and a half, you don't have to wait to 5 years. You can pull out the amount you converted at any point. Again, I wouldn't recommend it because you lose the value of the Roth. This is kind of like a little flow chart of how it works. I personally think the steps is easier to understand, right? Make a traditional IRA contribution. Like on our forms, you'll be able to say backdoor. You'll tell us. Then you don't obviously take the tax deduction for it. We'll then move it to the Roth. We'll code it on the 1099-R so the IRS knows it's a non-taxable conversion. And then you're in a Roth IRA and you can kind of invest it as you see fit. Super easy. We actually don't charge for like the extra account. If you're going to open the traditional and then go to Roth to do a backdoor, we're only going to charge you for the Roth. We're not going to charge you for the traditional. So don't worry about paying two fees. We don't do that. We actually don't even have conversion fees. We actually don't even have wire or transaction fees. So we're really good about this. Okay, the pro rata rule, something that a lot of folks don't understand. This is how it works. So in the easiest sense, you make more than $240,000. You don't have any other IRAs out there, and you want to do a Roth IRA. You can't because the Roth IRA distribution rules say you make too much money. Like, let's say I'm Jeff Bezos, I make $1 gazillion. I can't do it. The funny thing with billionaires is most rich people actually take very small income, right? So they get most of their money in stock and they make most of their money in investment income. So there's actually billionaires out there, and I know because I work with them, that do Roth IRAs because they have like a $200,000 salary, even though their income is like $20 million or $50 million for the year. So it's kind of funny. The people that kind of get hurt by these rules are like the lawyers, the doctors, the accountants, the professionals that actually make all their income in W-2. And most of those folks aren't billionaires. They get hurt, so they have to do the backdoor, whereas like the Jeff Bezos and the Warren Buffett, they take like $1 salary, right? Or $10,000 or $100,000 salary, or Elon Musk, and they make all their money in stock options. So it's kind of funny. But so the simple example, I have a Roth IRA. I make too much money, and I want to do a Roth. So I put $7,000 into a backdoor after tax to Roth, and it's all Roth because I don't have any other IRAs out there. But if I had other IRAs out there, this pro rata formula would kick in because I would have to account for the fact that I have other pre-tax IRAs. So it's a simple, here's this basic example, right? You have $5,000 in a previous IRA. You want to do a backdoor Roth IRA of 5. 5 is 10. 5 divided by 10 is 50%. So 50% of the backdoor Roth would be tax-free, and then 50% would be taxable, attributable to the other 5,000. Something to keep in mind. A lot of people don't understand this rule. I think a lot of it, I personally believe most of it never gets reported properly because no one understands how the rules work. And I don't think the IRS is actively looking at 5498s and 1099s and conversions. So I'd say probably a good portion of this stuff is never getting reported. But That's not my problem. So anyways, if you're a client of ours, we'll help you through this and work you through it. It's not really a big deal. Let's talk about Roth IRA conversions, okay? This is a fun area. So this is not a backdoor, because this part of the presentation is going to focus on moving pre-tax to Roth, not after-tax to Roth, pre-tax to Roth, meaning I have a traditional IRA and I want to go Roth. Why do I want to go Roth? Because I want to shelter all the income from tax, right? That's why you want to do Roth. You want to generate tax-free wealth. A traditional IRA, I have to pay ordinary income when I take the money out. Once I'm over 59 and a half, I can pull the money out, but I have to pay tax, not capital gains tax, ordinary income tax, which has a high tax bracket of 37%. If I pull the money out in a traditional IRA prematurely, it's ordinary income plus 10%, which is a premature distribution under the age of 59 and a half. So the Roth will eliminate all the tax. So long, again, as I have a qualified Roth IRA distribution, meaning I'm 59 and a half, the Roth's been open at least 5 years. Okay, you need the both, 59 and a half and 5 years. So there's obviously a lot of reasons to do a Roth and convert to Roth. As I mentioned, it's very hard to build up a substantial Roth account by just doing Roth contributions. You have to take into account income limitations. Yes, you have the backdoor Roth option, but you're limited to $6,000, $7,000, $8,000 a year. It's awfully hard to get to $1 million just through contributions. So 2 other ways to build the Roth. Obviously, you can make great investments like Peter Thiel. You can also do conversions. Okay, conversions is pretty simple. You literally take what's in your pre-tax IRA, whether it's cash or an in-kind asset, and you literally tell the custodian, IRA Financial, that you want to convert it, and we'll convert it for you. Cash, obviously, you pay tax on the value of the cash. Now, you don't pay tax that minute, right? What happens is we'll 1099 you for the conversion, and then that amount of the conversion is added to all the other income you earned during that year, and you'll report that on the 1040. So let's say you made $100,000 as a lawyer, and you do a $50,000 conversion. Now you pay tax on $150,000, whatever your tax rate is. Okay. Now, if you have other sources of income, capital gains, interest, dividends, and the such, right, all that gets added to your 1040. But you don't pay tax that minute. You pay tax on April 15th. So if you do a conversion in February or March, you don't have to pay tax until April 15, 2025, right? So generally, you don't want your IRA to pay tax or your Roth IRA, because you're just basically taking money from one hand and putting it in the other, and the other hand's the IRS. So it's not really helpful. The way you pay the tax is you pay it personally. Now, the problem with that, obviously, is it's tax. So you need to have the cash and the cash flow to pay the tax. So that's something to keep in mind. So these are, let's spend a lot of time, well, not a lot, let's spend a considerable amount of time on this slide, because this is really the crux of whether you should do a conversion. And I'm going to preface this with, there's no right answer. The answer I give Joe is not the answer I'm going to give Jane. Why? Because it's based off a lot of different factors. Your age. Can you pay the tax, right? Are you a good investor? Or whatever you do goes down, and maybe you should do a Roth. What do you think your tax rate will be when you're older? You think you're going to be working forever and in a high income tax bracket, or retired in a low income tax bracket? What's your goals? Right? Do you want to leave this to your family? Is this something you're going to use? Do you trust yourself? Right? Do you think you'll be able to wait till you're 59 and a half and Roth open 5 years to pull it out? Or do you not trust yourself because you generally are not the most diligent saver, and there are times during the course of a decade that you tend to need money, and you may raid your retirement account because you've done it before. So these are all the tips to consider. And again, I can talk to 100 people and have 100 different answers of should you do a Roth. And yeah, you may say, Adam, you're just covering CYA, you're a lawyer, and that's what lawyers do. They never want to give you an answer. No, a lot of lawyers do see the CYA and are scared to give you an answer. I'm not giving you legal advice here, right? There's no attorney-client privilege. I'm telling you the truth. And the truth is, I can't, on a live video, tell each one of you what works best for you and if should you do a Roth conversion. But what I suggest is going through each of these factors. So let's do some scenarios, right? someone who's 25 years old should probably think about going Roths more than someone who's 84 years old, right? You just have more opportunities to save. But let me preface that. Let's say the 85-year-old has a lot of losses. And let's say that 85-year-old has $400,000 in a traditional IRA and has $400,000 of losses to offset the conversion, or $200,000 or $100,000 that would offset the tax on that conversion. Maybe the 84-year-old actually has a better opportunity than the 25-year-old that maybe makes $1 million and has no losses and maybe can't afford the tax. So that's what I mean. You can go through each bullet point, and based off that answer, that would add clarity as to whether a Roth IRA conversion would work or not. Like, can you pay the tax? Obviously, if you can't, don't do the conversion. But you can do conversions every year. So let's say you have $75,000 in a Roth IRA and you're 40 years old. You can do $7,000 a year for 10 years, right? Or whatever, $4,000 a year for 10 years. You can do whatever you want. You don't have to do it all at once. The losses, that's important. You have net operating losses, losses from a Schedule C, from a partnership that flows through. That's an active loss, not a passive loss that can be used to offset against the business income. Here, you'd want to work with your accountant. What's your tax rate? Right? Are you in a super low tax rate now? Do you think your tax rate's going to go up? Maybe you took a year off work. Maybe you're in a tax bracket where you have $100,000, $150,000 of wiggle room, right? Let's say your tax bracket is at a point where you can increase your taxable income by $100,000 or $50,000 and still pay the same tax rate. Maybe that's helpful. What's your income going to be at retirement? Are you a lawyer going to work to you're 80 years old and make high income and pay a high tax? Or are you going to be on the beach, play tennis, play golf, ski, and literally you don't need a lot of money where you'll have a low tax bracket and maybe a conversion doesn't make sense, right? Here's another example, right? Someone comes to me and says, hey, Adam, I got $250 in an IRA. I'm 55, but I'm going to retire soon. And I don't really need a lot of money. I have a cabin in Colorado. I'm a ski bum. I don't really care about money. I'm going to pay I'm probably under a 15% tax rate. I don't need that much. Everything's paid for. My house is paid for. I have no kids. I just need food and wine. Then I'd say, you know what? Maybe a conversion doesn't make sense because, what are you saving? You're only going to save that 10, 15%. Maybe it's not worth it, right? Time value money. Why give up that money now? Who cares if you pay 10, 15% in the future? You have no kids. You don't have to worry about tax-free legacy. Yeah, maybe a conversion doesn't make sense. Versus I'm going to be probably at a very high tax bracket, no matter what that is, whether it's 30, 40, or 50%, right? We don't know what the future holds in terms of tax rates, but I'm going to be working and I'm a professional and I make a lot of money. So I'm assuming I'm going to pay a lot of tax. Then a conversion has more value today. Okay, so this is the kind of stuff that I love talking about. You're a client of IRA Financial, reach out to us, reach out to me. This is something that you can have fun with. Why? Because there's no right answer. So I can't be wrong. And you can't be wrong because you don't know the future, but you got to have a plan, right? If you know yourself and you're a great investor or you have an unbelievable opportunity, there's a private company you think can go public in 2 years and the stock's worth $2 now and it could be worth hundreds or thousands in 2-3 years, then converting that stock makes a lot of sense, right? You just got to know yourself, right? Imagine you converted Tesla 4 years ago or Bitcoin 3 years ago, you'd be pretty happy. But if you converted Silicon Valley Bank 3 years ago, you probably wouldn't be happy, right? Because that stock's worthless now. So that's the game you have to play. There's no guarantee. You could have a strategy, kind of know where you'll be from an income tax bracket, at least personally. You don't know where the federal rates are, but you'll know personally, will you be earning money? Will you be working? Are you a good investor? Do you just invest in money markets or do you actually take a lot of chances and have huge home run upside potential? Now, obviously the worst case scenario is, the Enron, Lehman Brothers, Bear Stearns, Silicon Valley Bank, where you have your money in that asset class, you do a conversion, you pay tax at a high value, send that money to Uncle Sam, and then in the future, the asset's worthless. And you just pay tax at a high value and you got nothing to show for it. That is obviously the worst case scenario. Most of the scenarios are somewhere in the middle. On the flip side, the best case scenario is, right, the Peter Thiel examples I gave, where you turn a few thousand into 25 million. And I've had clients do that with private stock to public, some in hedge funds and private equity. I have a number of clients that have 10 million or more in a Roth IRA. I have some with over 100 million. I don't obviously want to give figures out. It's confidential, but we have, I think, a strong specialty in working with high net worth folks on conversion strategies and Roth strategies. I'm not sure anyone in the country does this stuff better than us, and I think people understand that. So obviously, I don't want to give up too much. This is the kind of stuff that we work with individually with clients, but the most important thing to remember is this, okay? To build up a strong Roth, and I think everyone should be saving in a Roth because it's literally the best tax shelter out there for your lifetime and on death. Remember, the best way, obviously, contributions help. Obviously, if you're in a Roth 401k, you could put away 23 or 30,500. I will do in the future a masterclass on the mega backdoor Roth 401k, where in 2024 you can go 69,000 or 76,500 all in Roth if you are self-employed. Some businesses allow you to do that, but very few. So contributions, conversions is really the second best way to get into a Roth, and third is being a great investor, where you can take a very small amount of Roth funds and build them into a tremendous amount of tax-free wealth. But the conversion is a very important aspect to it because there are ways to get discounts on conversions. So the first way to get a discount is obviously you want to convert an asset that's been depressed. Like if you did a Roth conversion of Bitcoin when it was at 15,000 and now it's at almost 70, that was smart. Or if you had a piece of real estate that was severely depressed, or a piece of land, or a stock, right? If you did a conversion of Tesla when it was 2019 and the stock was depressed and there was a chance of bankruptcy, you're doing well. But again, no one knows the future. So you have to know your investment. That's why it's a very personal choice. But there are some strategies that you can do irrespective of that. One is called the discounted valuation strategy. And we work with a number of appraisers across the country that, based off your situation, could give you a discount in value. Why is a discount in value important? Because if you convert an in-kind asset like land or real estate or an LC interest, that's in-kind, right? It's very hard to get a discounted valuation on cash, right? Like you have $100 in your pocket, like you can't get a discount on that. It's $100. But if you have a piece of land that's pretty hard to sell, you potentially get maybe anywhere from a 20 to 40% discount. And that matters because if that land, according to an appraiser, is not worth 100, but maybe worth 40 or 50 or 60, you pay tax at a lower value. Or based off the family limited partnership rules, which a lot of wealthy family used to get discounted valuations when they moved assets out of their estate into irrevocable trusts, they would set up family limited partnerships, and based off the fact that it's in a partnership, lack of marketability, the fact that minority interest in this family limited partnership, they would get anywhere from 20 to 50% discount. So that helped because it reduced the gift size, it reduced potentially the tax on that transfer. And if you have a unified credit of whatever, 10 million, 15 million, obviously, and you have tremendous amount of assets, if you can get discounts on those assets, you'll be able to fit more assets under that unified credit amount. For us, people that don't have 15.2 million, that's not an issue, but you can use the same principles on a Roth conversion. So we have appraisers across the country that will work with you. Sometimes it's not possible, but if you do have an in-kind asset like an LLC interest, a partnership interest, or land, or an asset where you have a minority interest in, you will be able to get a discount on it. Will the IRS always agree with your discounted value? No, but you have at least the option to provide it. Now, I can tell you in a Roth conversion setting, it's very rare for the IRS to fight a valuation. Why? And I've said this before, and a lot of people just can't believe it, but the government likes Roths, and they love conversions. And you're like, wait, why would they love conversions? I'm pulling all my assets into Roth. And then once I'm 59 and a half and the Roth's been open 5 years, it's all going to be tax-free. Why in God's green earth would they want that? In 8, 10, 20, 30, 40 years, they're not going to get any tax revenue from the Roth. And if more and more folks are in Roth, they're going to lose this tax revenue. I've said it before, I'll say it again. Governments don't care what happens past 8 years, generally past 4 years, right? They just want to get elected. They want to stay elected for a couple terms and then kick the can down the road, someone else's problem. That's why they love Roths. Roths, remember, there's no tax deductions for Roths. Traditional IRAs include tax deductions. So the government doesn't love deductions because it reduces the tax base. And if you have a lower tax base, that means there's less money to spend on whatever the government spends their money on. Who knows, right? There are some good stuff like roads and military and education, security, that type of stuff. But there's also stupid stuff the government spends their money on, which we don't want to talk about today. So if you limit deductions, they just have more money to spend. And again, since governments only care about what happens in the next 4 or 8 years, the more money they have to spend, the more money they can spend on buying votes and making people happy. Generally, you'll vote for a party if they give you money in your pocket. It's generally the way it works. And that's not a Democrat-Republican thing. It's just the way it works. So obviously, if they limit deductions, they'll have more money. Now, in conversions, what a conversion does is it's a premature tax payment, right? It's very, very exciting for the government to get money from tax base prematurely. If I didn't do a conversion and I had a traditional IRA and I was 25, 35, 45, 55, they would have to wait at least till I'm 73 to get that money. Maybe earlier if I took a distribution, but at least to 73 years old. So by doing a conversion and by encouraging conversions, you're prematurely paying that tax, which is great. Now, going back to the financial crisis of 2008, in order to increase the tax base, because everyone's income dropped and people had so many losses because real estate values dropped so significantly, they had to encourage people to do conversions because it was an easy way to get more tax revenue quickly. So they actually allowed you to pay the tax over 2 years. We'll see if that ever comes back. I hope, God willing, we never have another 2008, but that's something they had in their back pocket and they used, and it definitely encouraged conversions. I remember when I started the business in 2009, we were super busy with folks doing conversions because they had 2 years to pay the tax. They basically were able to split it over 2 years. So I mentioned this earlier. I want to mention this again. If you do conversions, there's a 5-year window you got to wait. If you're over 59 and a half, you can pull whatever you convert out right away. If you're under 59 and a half, you got to wait 5 years and 59 and a half to pull everything out. Okay, so just remember that. Conversions have a different 5-year rule for every conversion you do. So if I do a conversion every year for 10 years, there's a new 5-year window every year. Okay, so just work with us on this. If you're thinking of doing multiple conversions, talk to us. We'll help you do it. If it's just one conversion, then remember, if you're over 59 and a half, you got to wait 5 years for the earnings, but the amount you convert, you can pull out right away. If you're under 59 and a half, you still have the 5-year and the 59 and a half rule. And IRA Financial, you don't have to, it's obvious, right? We literally wrote the books on self-directed IRAs, Roth IRAs, 401k. So if you want to set these structures up and you want someone that not just sets it up, but will give you design, customization, compliance, tax reporting, tax filing, annual support, we're the best around. That's it. That should be everything you need to know about the backdoor Roth IRA conversion, Roth IRA. I kind of hit everything. There's a question here, so let me answer it. We actually linked to the PowerPoint, so if you had trouble looking at it or just want a copy of it, you can click the link in the comment section and you can check it out. Daphne asked a question, can my husband transfer his traditional IRA to a Roth IRA? Yeah. So this is something, Daphne, I should have mentioned. If you have a traditional IRA and you want to go to a Roth IRA, you would need to convert it. Okay, so it's just a conversion. You can transfer a traditional to traditional, but if you want to go IRA to Roth, you can do the transfer from a traditional to traditional, but then you got to convert it to Roth. The only difference between a transfer between IRAs and a transfer between an IRA to Roth is that transfer has a conversion tax, which is ordinary income, right? You can go Roth to Roth tax-free, IRA to IRA tax-free. If you want to go IRA to Roth, you got to pay the ordinary income tax on the amount you convert. Can you go Roth to traditional? No. Once you're in the Roth world, you're locked in. In the old days, a couple of years ago, before 2020, you were able to have a year to get out of the Roth. Let's say you did a conversion in March and you bought Silicon Valley Bank and you didn't like what happened. You were able to get out of it. They stopped that. They should bring that back. It's not fair. So now once you're in, you're locked in. Although, until you get your paperwork, if we haven't processed it, we can work with you on that. So if you're a client of IRA Financial, you definitely have benefits. We can work with you and help you the best of our ability, within the confines of the law. That's it for today. That should be everything you need to know on Roth IRAs, Roth IRA conversions, backdoor Roth IRAs. If there's anything I missed, reach out to my team, to me, and we will take care of that. I'm hoping you guys are enjoying these master classes. I've got some amazing feedback, so thank you. Topic next week. I'm thinking I'm going to stay in the self-directed IRA world before I move into the solo K. So next week, I'm going to be talking on self-directed IRA. Let's do Roth strategies. I think I'm going to do some Roth strategies, mostly talking about founder stock and carried interest and some of the cool strategies that I've encountered over the years. It'll be a lot of fun. I'm not going to go in too much detail because that's somewhat confidential, but I'm going to go through in general some of the really cool Roth strategies that people have done, whether it's from locking in tax-free gains, estate planning, stuff like that. So it's going to be kind of a follow-up on today's, and ultimately we'll get into some prohibited transaction stuff in the following weeks, unrelated business income tax, and then kind of move into the 401k world at some point as well and talk about solos and some of the amazing stuff you can do. And that we'll get into Rob's and kind of keep it going for the rest of the year and see where we're at. So thank you guys for hanging out with me today. I hope you enjoyed the video. This should be everything you need to know. If you have more questions, I'm sorry to answer it. Reach out. We'll get those questions answered. Otherwise, have an amazing rest of your day, and I'll see everyone again next week. But don't forget to subscribe. We drop 3 to 4 videos every week. Also, I went live yesterday. There was a recent northern Alabama court case on the essentially the constitutionality of the Corporate Transparency Act. So I just went live because the case ruling came out a few days ago, and it basically invalidated the CTA, although it probably will get appealed and it may even go to the Supreme Court. So you should definitely still comply with the CTA, but it was a really cool case. So I just went live with it. So if you subscribe, you'll know when I go live, and who knows, maybe I'll go live tomorrow, next week. We'll see what pops. But if anything's interesting, I will just go live and kind of do a quick video on it and have some fun and hopefully interact with all of you and keep you guys in the loop, educated, so you can be the best and smartest and most successful self-directed retirement investor, and hopefully using a Roth so you can shelter everything from tax. Take care. Have a great day. I'll see everyone again soon. Thanks.